Welcome to Harvest Financial Advisors Quarterly Update. I'm Marc Henn, CEO and founder, and this video update is for the quarter ending March 31st, 2025. In this update, we will review current market and economic conditions, the current administration's policies which may impact portfolios, and what we see upcoming for the economy and markets. I have shared with several of you over the years that I do not expect unbiased reporting in our news media. Depending on the news source, you may get wildly different viewpoints on the same story. Knowing the bias allows us to understand both the attitudes and conclusions of the journalist. I also have shared with some of you this year that I'm not concerned or worried about the stock market's reaction to the happenings in Washington. Now, don't take that to mean I don't care. We are actively monitoring and extremely conscious of what is transpiring. It is important for you to know that I am one that typically remains calm and level-headed due to my belief in the resilience of the economy and to a disciplined investment strategy. We look for opportunities and how to design the portfolios, and this all starts well before a downward trend begins. Now, in some regards, this is a more difficult newsletter to write because of the highly charged political environment in which we find ourselves. In other regards, it is easier to write because the new administration has been transparent about what it is trying to accomplish. Our goal is to weed out the noise and look at what is actually occurring. We utilize all the available economic data and review all regarded analysts' research to guide and inform our investment decisions. This starts by removing emotions, especially fear and greed, from our process. It also means looking objectively at the current situation. So, without further ado, let's dive in. The Trump Administration 2.0, Policies, Positives, and Pitfalls. Specifically, we will look at three major areas that the administration wants to address. I want to start by saying that after a few good years in the market, coupled with high valuations, a pullback of 10% at some point this year, and maybe even a bit more, was definitely possible. We didn't know what the catalyst would be at the time, but it now appears clear that tariffs became that trigger. First, the positions of this administration. One of President Trump's primary objectives is to address the stagnation in industrial sector employment in this country. Michael Cymbalist, chairman of market and investment strategy for J.P. Morgan Asset Management, provides some great visuals that we will share with you. Now, as you can see, since China joined the World Trade Organization in 2000, GDP and consumption has been increasing. Yet, over the same time period, we see that employment and industrial production stagnate. The current administration believes this is due to the lack of tariff reciprocity and points out that most countries apply a higher tariff on the U.S. than we do on their goods. Second, Trump would like to fix the large trade imbalance of goods that has grown consistently for multiple decades and has significant consequences as a result. Namely, a Chinese supply chain that feeds into multiple industries, particularly those dealing with national security, such as semiconductor manufacturing and rare earth minerals. Additionally, our dependence on foreign pharmaceuticals is significant and itself can be considered critical in terms of both health and cost. Third, he wants to address the federal debt and its sustainability. The Department of Government Efficiency was created to tackle this very real problem. One interesting fact is that the Government Accounting Office can identify $200 to $250 billion in improper payments after the fact, but has no system in place to stop them from occurring. Now, there are other areas that the administration wants to tackle, such as immigration, the border, the military being short of munitions after funding the Ukraine war, wanting to end the Ukraine war, increasing transmission line and pipeline growth, etc. Now, the commentary on these areas can be lengthy, and I'm sure you don't want to hear about the ins and outs of bilateral tariff agreements, so I will hit some high points. From what we can see, there's little evidence of a connection that trade deficits and manufacturing decline go together. Productivity, automation, and cost of labor are probably more to blame for the industrial employment stagnation in this country. Tariffs can be inflationary, but ultimately, if they are high enough and they stick around, they may lead to declining growth, which no one wants to see, including the Trump administration. His first administration did not see inflation when utilizing tariffs, in part because those tariffs were smaller, but at the same time, there were no substantial gains made either. This time around, a tight and tightening labor market due to immigration reform creates an additional level of complexity. Additionally, we all know that government fraud and waste need to be addressed, despite the jury being out on whether DOGE is the right fix for this. One last note on tariffs. This will continue to evolve, and the consequences are somewhat complex. Some sectors will face some pain, while others will benefit from the administration's stance. In addition, because globalization has now been entrenched into supply chains, no matter what the reason for unwinding globalization, such as national security or control over pharmaceutical distribution, there will be higher costs as a result. While the trade imbalance may not be addressed by tariffs, what is having some footing is foreign companies committing to building manufacturing facilities in the United States to avoid the tariffs. Ultimately, this may be one of the main goals. In addition, there are several pro-growth strategies the administration wants to roll out, and I was somewhat surprised that these were not implemented simultaneously with the tariffs. This is still to come. With that brief walk through the administration's focus, where does that leave us? It's widely understood that Trump uses tariffs as a negotiation tactic, being willing to enact and retract them at lightning speed when opportunities are present that he believes benefits the United States. With the market downturn at the beginning of February, we believe pressure is building on the administration to negotiate a bit faster, take the victory where it can, and help reduce the volatility that is roiling markets. Now, if this happens, we might see the EU removed from the crosshairs, but China will remain a focal point. While this could spark a market rally in the near term, we see this as only the first step in the process of reducing the trade deficit. At the end of February, we believed economic growth was on the horizon, the elusive soft landing was here, and there was little chance of a recession. This has shifted somewhat with lower expectations of economic growth and the potential for additional interest rate cuts before the end of the year. We're not calling a recession yet, as we see the tariffs as more of a stumbling block at this point, and we should have a clearer understanding over the next 3 months of how economic activity responds to this uncertainty. Some additional positives that are on the horizon would be lower oil prices, U.S. bank capital reforms, pro-investment extension of the 2017 Tax Cuts and Jobs Act, and the aforementioned potential Fed easing. Looking ahead, markets have already pulled back a decent amount, and it's important to remember that equity markets will recover prior to the economy, meaning equities typically bottom out first and then recover first. If we look at this chart, we can see that historically, in years where markets have a 15% pullback, there's an 83% chance that they will be positive at the end of the year. Thank you again to JP Morgan for providing this chart. The individual stock portfolios have held up very well during this cycle, and we are very pleased with this. We also expect fixed income to have a good year as well, and we are off to a good pace. To recap, in this video, we reviewed current market and economic conditions, the current administration's stances, and what we see upcoming for the economy and markets. If you have any questions, please do not hesitate to contact our office. And as always, we thank you for your trust.